Welcome to the Four Seasons Podcast, brought to you by B&H Wealth Strategies, serving Northeast Tennessee and Southwest Virginia since 1966. Here, we guide you through the ever-changing seasons of your financial journey, offering insights to help you grow, protect, and enjoy your wealth. Ready to turn your financial dreams into reality? Dare to dream. And now, here's your host, President of B&H Wealth Strategies, Jeff Bingham.
Market corrections can feel alarming, but they're often a normal part of long-term investing. Jeff breaks down what is really happening beneath the headlines. Welcome back, everybody. Skip Monty here, co-host / producer, back in the studio with President of B&H Wealth Strategies, Mr. Jeff Bingham. Jeff, how have you been this week?
Skip, I've been good. How about yourself?
I'm doing great. It's hard to believe we're moving into fall already, or starting to head in that direction, but that's okay. I like it a little cooler anyway.
Well, yeah, I expect we've got some more hot weather, but yeah, it is hard to believe that we're already into the, I guess we're finishing the first week of August. That is incredible as we sit here and record today. But it's also, that means it's almost football season again. So
That's right.
roll for
Almost
go
football.
balls.
Football time in Tennessee.
You bet.
So, Jeff, it's always good to sit down with you and get the deeper picture of investing and finances in today's world. Today's topic is market corrections and what they really mean to the average investor. Please walk us through how you define a correction and why does it matter?
Well, I'm going to start by asking everybody out there a question. If the market fell 5,000 points today, would you sleep well tonight? My clients, I think, typically will sleep well. And the reasons why that is are many, but basically we prepare for this, right? We talk about these things. We know that when the screen turns red, the headlines scream more is going to come behind this. My clients don't panic. They know they can pick up the phone and call me. They know we've gone through this for, the 60 years that we've been around as a business. I've been doing this for 35 years myself. So we've seen these things before. My job, my work with my clients, the conversations that I have in this room with them are about, separating the news from the noise, or the noise from the news, and finding the appropriate signal. So again, they can always pick up the phone and just ask Jeff, what's going on. We're also built for this. We build our portfolios, and we've been doing this for years. We are always, we're always trying to make money, but we build for protection and participation strategies. So we're built on a rock, not on the sand. So the winds are not going to blow us over. So we know they're going to come and go, right? The market corrections are going to happen, but we are built to stand through this. And again, what I always tell people is that, and this is what happens, even with those things in mind, and people know that we're in this fight with them. They can always pick up the phone and call 423-247-1152 and just ask me, just ask Jeff, what's going on? Is this something that I need to worry about? Is this something that we're going to get through? Don't let it fester. But we are here. We have been standing through these things with our clients for, like I said, I've been doing this for over 35 years. We've been standing with our clients, for 60 years. Market corrections are basically the toll, if you will, that is paid for the long-term results that you get out of markets. And so, but when you put together, as we're talking about being built for these things, you have money that is in the short term that you need to get to, right? And so that money is safe and secure. It is built on in a different structure, if you will, than the longer term money, which is trying to grow and keep pace with inflation, beat taxes, and make sure that you're protecting your purchasing power in the future. So that's the way we've been built. That's where we are. That's how we stand through these, and have been doing this for 60 years now.
Well, apparently, it as you said, it's kind of normal. How normal is a market correction?
Yeah, if you look back really over the last 100 years, but certainly over the last 36 years now, there is no, they come along like clockwork. The problem is you don't know what time on the clock, but if you look at a calendar every 12 months, every 12 months, you're going to see a market correction. That's by historical measurements. So again, it is the price that you pay, if you will, for long-term results, the toll that's there. But in most of those corrections, and I'll talk about what a correction is, how we define that in a minute, but most, if they happen once a year, like clockwork, markets are also positive most of those years, right? So they finish the year in the black, even though there will be some red during the course of the year.
Hmm. Very interesting. And to what level? I mean, I'm sort of a novice at this, which is the reason I enjoy talking with you, is I learn a lot. Define what what defines a market correction as far as like what parameters, how big of a dip, or talk about that.
You actually hit on a couple of things right there. You use the word dip. That was what I'll say. A dip is, we would define a dip. I'll start there, right? The kind of the smallest pullback, let's say, or turn down. A dip is going to be less than 10%. So a dip might be 5 to 8%, right? So, and those again happen with great regularity. I mean, you can be in volatile moments. Think back to March of this year. We'll touch back on that in a moment, or April of last year when the tariffs were announced. I mean, we would see, when in those days we might see a 3 to 4% dip in a day. That's not a correction. A correction is defined by definition is 10% or more, right? 10% or more. If you go up and you touch 20%, that's where you hear the term bear market. That's officially where a bear market begins by, kind of academic definition would be at 20% or more. The frequency and the average of those, again, I said once a year for market corrections for the last 36 years now. And the average correction is actually minus 14%. But again, I point out most of those years, even with a minus 14, correction that falls in the correction, the market finishes in the black for the year. And again, once a year, when bear markets happen on average about once every 6 years. So that's kind of dips. I mean, you could have, you're gonna have multiple dips during the course of the year. We've had them all year long. We got a market that's at red record territory. Corrections, again, are also the norm, not the exception. A year when we don't have a correction, that pullback at 10% or more is really an outlier more than it is, more than it is the norm, right? That is the norm. So, and they think back just in the most recent memory that we have, using the S&P 500 as our proxy to measure the market with in March of this year, as the war started in Iran, uh, we the S&P didn't go down 10%. It was down a little over 9%. And keep in perspective, from that low at down 9% from peak to trough, at roughly 9%, we are 19% above that low right now. So again, almost a correction. They're normal. The signal is still strong, right? It wasn't signaling weakness in the economy and in the markets. We're built for this. Right now, the market's back up. It's plus 19 from the bottom, and we're plus, double digits on the year right now. So, you can just kind of see that's where you really have to, that's where I always go back to just ask Jeff, right? You want to kind of dig through these things. We're doing this podcast to try to get information out there of folks to try to have them have some understanding, but also, kind of get some comfort and, through this so they don't, have that panic moment when they see the screen turn red, because surely it is going to again. Like I said, like clockwork. But we stand in that moment, shoulder to shoulder with our clients. We've, if you will, we instruct, we teach, we counsel all the way through these things with our folks.
Very good. Well, speaking of that, what if you could think of one misconception that people have about corrections? and the one thing that you wish people understood better, what would it
Well,
be?
it's a great question. I think one thing it's the frequency and that they occur with, right? That they're normal. They're really like any. I mean, think about a correction. Think about just what the term correction means. Something's not right. Something's not working exactly right. Maybe we've gotten a little ahead of ourselves. The word correction means that we're checking where we are right now. We need to look at this. So it's not even the word itself is not necessarily a negative term, although we kind of think of it as a negative term. It can be instructive, right? I think a correction in the market is a bit is constructive to kind of see, has the market gotten too far ahead of itself from a pricing standpoint, right? What we call the valuations. In other words, we're looking at these record highs right now as an example, and I'm not saying that there's getting ready to be a correction. That's not what I'm saying. But you look at these right now, and if we see a correction and the underlying fundamentals necessarily haven't changed, then is it just the market checking itself, correcting itself for a moment to say, uh, are we too far ahead of where we should be? Is this pricing right? Because the market is a forward pricing thing. It's not really doesn't price in the current, it prices in the future. So again, a correction says, maybe the pricing that we're thinking about in the future is not quite there. That'll be an interesting thing when we'll talk about, AI and things of that nature as we talk maybe in another podcast, uh, thinking about what that looks like and those pricing mechanisms. So again, I think it was a long-winded answer, and I'm sorry for that. Um, but I think what I would want people to know is that this is normal, right? These happen with great frequency, and a correction is not the end of the world. A correction is not a bear market. A correction is not a crash. I mean, I think people today get so inundated, right? Wherever we're getting our news from, whether it be traditional television, CNBCs of the world, or whether we're getting it in podcast, or whether we're getting it in some whatever form we're getting it in Twitter, whatever, or X, I guess it is. Um, it we automatically hear these numbers, and the numbers are so big right now. I mean, because you can say, a 10%, a 10% correction using the Dow Jones Industrial Average as it at 53,000, roughly where the Dow is right now. That if I, as the first question I asked, if the market went down 5,000 points today, would you be okay? That technically wouldn't even be a correction, would it? It wouldn't get quite to the 10% level. But that 5,000 number would absolutely freak people out, right? And so that's where when we when we're working with our folks, our clients, we have to keep in perspective the numbers. I mean, we just throw the numbers are so big now, $40 trillion worth of debt. When we talk about it, we used to talk about millions, then we started talking about billions, and now we talk about trillions. These numbers are so big and so staggering that they're overwhelming to people, right? We just kind of get numb to all these types of things. However, where it comes back very real from that numbness is Dow Jones Industrial Average drops 5,000 points today. Is that possible? Yes, it is, right? That would make it very real for people. That is red on the screen. That is red in your portfolio. That is headlines coming at you from wherever you're getting them from that says more to come, more to come, more to come. And that's where you have to break into separating noise and finding signal.
Well, I got to tell you, I feel a little more comfortable as a novice investor, and I'm a news junkie as well. So it kind of freaks me out. So I appreciate all the well defined information, and I do feel more comfortable. Hopefully, our listeners do as well. And if not, and it does drop 5,000 points tomorrow, what do? You call Jeff, right?
Call me. Like I said, you want to hopefully, like I said, and I think I can safely say this, our clients do. I mean, I've been through this. They've been through these battles, right? And these are battles or wars or whatever you want to call them. So the storms, if you will, that are out there, and there are more storms to come. So if you've got to be able to, again, to know that you have a portfolio that is constructed to survive the strong winds, that it's built on a rock, that if you have money that you need to get to in the short run, that it is in the right positions, that it is not subject to that 5,000 point drop, right? If you need that money because you have different structures that you have. But that long-term money that you've got, that growth, that inflation protection, the one that's going to beat taxes and inflation over time, that's going to continue to buy the things that you need 5, 10, 15 years from now, that money does need to grow, but it is going to have moments where it's going to hit these headwinds that are certainly looming out there. And it's okay, because it's not unusual. And that's where the calm, advice, counsel, and partnership, right, that we have with our clients.
Amen, brother. Well, Jeff, thank you so much for breaking all that down. Again, I feel more comfortable. Hopefully our listeners do as well. And we'll look forward to talking more about this in the next episode.
Sounds great, Skip. Thank you very much.
Thanks for tuning into the Four Seasons podcast, brought to you by B&H Wealth Strategies, where your financial success is our priority. Schedule your free 20-minute consultation today by calling 423-247-1152 or by visiting bhretire.com. Take the first step toward making your financial dreams come true. Until next time, remember, every season is the right season to plan for your future. Securities and registered investment advisory services offered through Silver Oak Securities, Inc., member FINRA SIPC. B&H Wealth Strategies and Silver Oak Securities, Inc. are not affiliated.